A call option is a financial contract that gives the option purchaser the right, but not necessarily an obligation, to buy a given quantity of an asset at a preset price, known as the strike price, by a certain date or time. To obtain this right, the buyer pays a premium to the seller of the option. The premium is primarily determined by the price volatility of the underlying asset, time until expiration, interest rates, and the difference between the option's strike price and the actual market price. Stock options are the most common forms of this financial instrument. When a trader buys a call option, they stand to profit if the price of the underlying asset rises above the strike price before the expiration date. The potential profit is in theory limitless, as it corresponds to the extent to which the asset price exceeds the strike price. If the price of the asset does not exceed the strike price, the buyer will simply allow the option to expire, limiting the loss to the amount paid for the premium. The seller, also known as the writer of the call option, meanwhile, profits from the premium received but is exposed to potentially substantial losses if the price of the underlying asset rises above the strike price. The option chain, also known as the option matrix, plays a key role in the trading of call options. It presents real-time quotes for each available call and put options contract for a security. An option chain provides information such as strike prices, last traded price, LTP, change percentage, volume, and implied volatility, among others, enabling traders to make informed decisions. Traders often use option chains to compare the prices of different options, assess market trends, and execute strategies. A shrewd trader can leverage call options to capitalize on anticipated increases in the price of the underlying asset. With a solid understanding of market trends and potential price movements, a trader might purchase a call option when they anticipate that the asset's price will rise. This allows the investor to profit from the price increase while limiting their potential loss to the premium paid. However, using call options as a trading strategy also comes with risks, as market trends might not always conform to expectations, and the option might end up worthless if the asset's price fails to exceed the strike price before the expiration date. Call options can also be used as a strategy to preserve capital. When an investor owns shares of a company, they face the risk of the share price falling. By selling a call option, the investor receives the premium, which can offset the fall in the share price to some extent. This strategy, known as a covered call, can help to protect against downside risks. However, if the share price rises significantly, the investor faces the risk of having their shares called away for the strike price, meaning they miss out on potential profits. Some traders use call options purely as speculative tools, buying and selling options without intending to exercise them. Traders can profit from such speculation by buying call options when they anticipate an increase in the price of the underlying asset and selling the options at a higher premium later on. Similarly, traders could sell an option if they anticipate the price of the underlying asset will decrease, and then buy it back at a lower price before expiry. This strategy, known as trading options for their time value, allows traders to profit without owning the underlying asset. Call options can also be used as hedging tools in portfolio management. Suppose a fund manager owns a significant amount of a single stock and fears that a short-term decline in that stock could harm the performance of the fund. The manager could buy a call option on an index of which the stock is a member. If the stock's price falls, any losses may be offset by gains in the value of the call option on the index. This strategy allows the manager to effectively insure against short-term losses. The strike price is a fundamental element of a call option. It is the price at which the option holder can buy the underlying asset. As the price of the asset rises above the strike price, the value of the option increases. Conversely, if the price of the asset is below the strike price at expiration, the option is worthless, and the holder's loss is limited to the premium paid. Therefore, the selection of the strike price plays a crucial role in the potential profitability of a call option. Another important aspect of options is the concept of time value. The price of an option often contains intrinsic value, which is the difference between the asset's current price and the strike price, and time value, which reflects the potential for the asset's price to change before expiration. As the expiration date approaches, the time value diminishes, a phenomenon known as time decay. This decay can affect the profitability of an option, especially in the case of call options, where the option holder stands to lose their premium. Traders have two primary ways to profit from a call option. They can either exercise the option or sell it. If the price of the underlying asset is significantly higher than the strike price, a trader can exercise the option, buy the asset at the lower price, and then immediately sell it at the market price for a profit. Alternatively, if the option's premium has increased due to an increase in the asset's price, a trader can sell the option for a profit. The latter strategy does not require the trader to have sufficient funds to purchase the underlying asset. Thank you for watching. If you found this video helpful or enjoyed it, please give it a thumbs up. Leave a comment down below to share your thoughts or questions. And don't forget to subscribe to our channel for more valuable content like this. Your support means the world to us, and we look forward to seeing you in the next video. Happy watching and happy trading.